chat or raise your hand. More than happy to answer questions, scenarios that come to mind as we're going through the presentation. I do not mind keeping it a little casual and answering questions as we go. My contact information is also directly listed in the chat for everybody. So if you have any questions after the webinar, feel free to reach out and we will do our best to get that deal structured for you. I think we got everybody here, so we're going to get started today. Welcome in. My name is Paul Seshariba. I run non-QM lending here at MLB Wholesale. We're talking about investor mindset, sourcing, structuring, DSCR transactions primarily in today's webinar. It's an amazing opportunity. DSCR is forever growing, it seems like, in this day and age. Seeing a lot more opportunity out there in the DSCR space. And one big thing we've noticed is it is less sensitive to the market, right? So less time of year sensitivity, less rate fluctuation sensitivity. Investors are always out there looking for the deal. So that is a great opportunity to smooth out some of the curves in your business the market might throw to you, is building a base of investor clients, helping people grow wealth with real estate. So we're going to talk about some ways that over my 16 years of origination, coming from your shoes before coming here to MLB, I was able to source these kind of clients, working with DSCR and other investment products. An overview of how powerful the DSCR loan program could be for those of you that are a little more new to it, as well as some tweaks or some suggestions on how to structure a deal to find the most amount of deals that work as possible, and a little bit of look into what short-term rental looks like, even though that's a tightening space in the DSCR field right now. We'll talk a little bit about some of that short-term rental income because it is a popular question asked by clients. So one of the nice things about the investor opportunity is we're really looking at a loan product that doesn't have traditional income, right? We're going to go beyond that W-2. We don't need bank statements for income. We really don't care if you have a job or not if we're looking at a DSCR transaction. We're looking at a piece of collateral, and our question to answer is, does this collateral cash flow itself? In a lot of ways, it can help an investor grow their portfolio faster to a much larger size than anything Fannie, Freddie, or income qualified. In the DSCR space, I really don't have a maximum number of units that can be mortgaged in my core product. I do have some restrictions in the premium product, but in the core, we actually just closed the deal for somebody with a 128 unit portfolio. Now, a lot of those are in LLCs, so they may not count Fannie Mae either, but that ownership, any mortgages that would be associated can impact your ability to income qualify. They are not near as important as long as they're current in the DSCR space. It's really an asset-focused lending product. So when you're out there pre-approving DSCR clients, it can be a little difficult to get a solid pre-approval because you don't have a lot to look at. You don't have any income to gauge off of on a purchase pre-approval. You're simply looking for, does the borrower have sufficient funds for the down payment on this property, plus the required reserves, typically between 6 and 9 months, depending on the loan amount you're looking at. Almost all of our DSCRs end up at 6-month reserves, but if you get up there to some of the larger ones over 1.5 million, you'll see a need for 9 months or potentially even 12-month reserves if you get up really big into the $3 million range. Where do we look for some of these DSCR transactions that maybe are not realtor driven, right? If we find transactions, especially purchase transactions, realtors usually come with them. What I did a lot as a producing originator is I would chase non-realtor referral business in the hopes of meeting a new realtor or giving a realtor I'm currently working with a potential client. So I like to chase things that weren't just realtor driven referral. Right now, we're so saturated with LOs in the market as well. These realtors are getting hammered with phone calls. So I prefer to go after the alternative options and let everybody else hammer the same realtors over and over again, perform and show a realtor how well I can do on a transaction, then ask for that meeting. For me, one of the big sources was property managers. I did meet a lot of those locally through meetups and whatnot, so it's kind of tied together with this investor meetup. But a property manager can be an excellent source for DSCR referral. They do get questions from their clients if they're managing bulk properties for people, not always for purchase transactions. They can be a great source of refis as well, as they find repairs needed on a property. Somebody may be looking for an avenue to try to pay for some of those repairs or improvements on a rental property. and I got quite a few referrals out of property managers. I also got clients for life from those. We execute that first DSCR refi for them. Now we're a part of every transaction when they buy that next property. CPAs and financial advisors, these are people that are already intimately involved in a client's personal financial life, and they really do not understand the mortgage space. My favorite intro in the door with a financial advisor is actually asset utilization over on an income qualified product. But as they're looking for avenues for their clients to diversify risk and grow wealth, real estate investment can certainly be a part of that. And for many of them, it is. That's a great opportunity to partner with a financial advisor, present to or talk to their customer base, and offer a way to help them leverage money up to 85% loan to value with no income needed to build out an investment rental portfolio as another component to their wealth building strategy. Builders and contractors. Excellent opportunity there with builders and contractors that work with investors. We've got a lot of referrals over my time as a producing LO from contractors that were looking for avenues to help clients pay for repairs, renovations, and other expenses. These are guys that are being invited into the houses already. They're being asked to do work on kitchens, bedrooms, bathrooms, roofs. As long as the house is in a rentable state, we can help fund a lot of those repairs that are needed, or we can pull money out of another property to fund repairs on one that's not currently habitable. So lots of opportunity in that builder and contractor realm to build relationships that can lead through to those referrals. Where did I meet most of these people? I met them at local meetups. Local investor meetups can be a great thing. Now, I did not see a lot of success going after individual investors at these meetups. My goal was to meet the other business professionals in the room. So they were a higher leverage play for me. They know more clients. They're out chasing clients as well. And building relationships with them led into referrals for me. My most successful referral relationships were actually with some local hard money lenders. These are guys that were going out and helping people buy auction properties, buy wholesale properties that needed a lot of work before getting on the rental market. They would help that client get the property renovated, get it rented, and then that's when I'm getting the phone call. I need this guy off my books. Can you help me price? Can you price something out for him? Because DSCR is so flexible in terms of licensing, you can operate through the majority of the country without a license on DSCR. There are state restrictions, and you'll want to check that business purpose restrictions section of MLBwholesale.com under products non-QM. It'll tell you where you can and cannot do loans without a license across the country, and it's ever evolving right now. So do check that every time you got a deal, because there are some states that are changing, and I anticipate we're going to see some more changes this year in that environment, albeit not many. But a state like North Carolina right now is on the tipping point. It may or may not change, but it is definitely in the gray. So pay attention for that. But those investor meetups can lead to a plethora of referral potential in that DSCR space with reoccurring repeat business, like those hard money guys. At one point, I was getting 8 deals or so a month out of a group of hard money investors, just helping them keep things off their books. They wanted them gone in 12 months. So how do we do a refi to get them gone in 12 months? We took 6 months. We got the clients in the door. We fulfilled a seasoning requirement, showed the property was rented on the market, provided a lease. Boom, we got a refi, got the majority of their cash out up 75%, and let them march on to the next project. DSCR lending. How do we really look at a DSCR? How do we qualify a scenario? So on that same web page, there is a DSCR calculator you guys can use. I'm going to flip from the slideshow here into that calculator for just a second after we go through the formula. But the way we calculate DSCR is the gross monthly rental income, so the total amount on your lease. We divide that by the total holding cost per month, principal, interest, taxes, and insurance, and we're looking for that number to be a 1 or better in a perfect scenario. That gives us the DSCR of 1. That'll give us better pricing, more flexibility in terms of LTV and FICO score. We can work as well with DSCRs in the 0.75 to 0.99 ratio category. However, those have to be 75 LTV, and the FICO range is a little more restricted. They are also a little bit more expensive. So if we can keep a loan into that positive cash flow territory, we really want to do that. At 80 LTV or lower, we can use interest only to qualify, which, depending on the loan amount of your DSCR, On a $150,000 loan, interest only does not save us much per month to close that gap. But on a $500,000 DSCR, that interest only conversion can save you $300 a month and potentially fill that gap and make it work. So there are avenues there to make things into positive cash flow that maybe start out as negative cash flow. You can also use buy down of points. So if we can lower the rate, lower the cost to make that ratio work, or something like that in combination. Certainly worth looking at options. On a purchase, generally speaking, you're going to assume that that ratio is a 1 or better. And then we would troubleshoot that particular issue when we saw an appraisal come back. Because on a purchase loan, we're going to use the 1007 value. Now, this DSCR calculator I designed is here to help you calculate that DSCR ratio. You're going to fill out these cream color buckets at the top with the data that you have. In this case, I've got a $300,000 loan amount with property taxes, insurance, no HOA fee. And I said it was going to rent for $2,500 a month. So we're going to say we got a 6.875 interest rate on this product. And that does lead to a cash flow positive DSCR at 1.03. See down here, it's nice and green. It tells you that it's cash flow positive. If you're trying to troubleshoot this or work with a client for expectation setting, that's why I have the comparison table there. It'll let you know what you can do up and down the rate stack and how that's going to move your debt to income ratio, so you know what flexibility you might have in any given rate stack. It's a great tool that helps you get a little more clarity around structuring the deal correctly to maintain that DSCR of 1 or better and what those interest rate adjustments mean to your DSCR ratio. Again, that's posted on the webpage. Celine posted that in the chat for us. Thank you very much. And that should be up there for you guys to use on any deals you've got. Let me get back to the presentation here. MLB has 2 different DSCR programs. We've got a core and a premium. The premium is meant for the experienced investor with a little bit cleaner scenario. It's really ideal for the person that's owned at least 1 rental door for 12 months, 680 plus credit score, 20% down, accepting a prepay in states where they are allowable. That's where that program is built to price a little better for a much cleaner DSCR type file. Our core program has a little more flexibility. It can work in instances with first-time investors, so I don't need any investment experience whatsoever. And I can potentially work with a first-time home buyer as well. Now, generally speaking, I do want some geographical separation to prove the home buyer's not moving in there. Remember, we're going to have to fight that reverse occupancy fraud component, which is the biggest source of fraud in the DSCR space. I've got to make sure that the buyer is not moving into a DSCR. The buyer can also not allow their family to live in a DSCR. It's got to be for business purpose specifically, so income generation to an arm's length renter. No personal income on a DSCR is needed with either program. It's actually very important. I do not even want income or employment on your 1003 when you upload the file. We want to make sure we don't see any of that. That can cause issues, believe it or not, on a DSCR. Since we are not looking at that to qualify, we do everything we can to make sure that's gone. First-time investors, again, that is welcome. They do have a little higher restrictions. They're going to be at 75 LTV with a 700 FICO and 12-month reserves with no investor or home ownership experience. A first-time investor does not have to meet those requirements if they do have a primary residence that they own. They can own it cash. They can own it under a mortgage. As long as they own their primary, I can have a lot more flexibility with a first-time investor. It's really the first-time home buyer where those restrictions are in play. LLC or corporate vesting. In some states like New Jersey or Illinois, that's a requirement to offer a prepayment penalty. It's generally preferred on DSCR. It gives a clear indication of business purpose, and we have no issue with that vesting. For both programs, though, we do need a minimum of 51% ownership of that company as a borrower on the mortgage. So I need 51% of the ownership of the company represented, and anybody with more than 25% ownership in the company, 25% or more, I should say, must be on the loan. So really the controlling owners have to also be personal guarantors. Now, question we get all the time, we do not report DSCRs to a personal credit report. That is what we do not, our servicer does not. However, it is up to the end servicer at the time the payment is made. Most of our DSCRs don't get sold beyond the initial servicer that we have in place. However, if they ever do, it is potentially possible that, especially if they go delinquent, you'd see those report to credit. By and large, DSCRs do not report to credit, and most servicers hold to that as well. DSCR Core Matrix, there's a matrix published on the same webpage for premium and for core. There is loan amount potential up to $2.53 million, depending on the LTV and the borrower's FICO score, with options from 85 to 75 LTV. On the low end, we will do a DSCR at a 640 FICO score. However, for a purchase, it must be a 75 LTV. Max LTV on your cash out is going to be 75 LTV as well, regardless of core or premium product. When we look at the negative cash flow component, so we go into a negative cash flow DSCR, you do become capped a little tighter in both purchase and refi. 75 LTV becomes your absolute maximum to work down in those negative cash flows. Just like interest only can push you over a 1 to qualify, it can also push you over 0.75 to qualify. I helped an LO yesterday structure a deal that was at 0.7 on a DSCR. We used interest only and a little bit of interest rate buy down to get that to 0.758, so just barely over the line, but that was a way to make that deal work significantly cheaper than a no ratio. For those extreme cases, we do have a no ratio DSCR product. It does tighten down quite a bit. It's a 700 plus FICO score. The rates are also meant for that essentially asset only loan. Really, at that point, we're just looking at the collateral and the equity. So if we can avoid it, we want to. If we can avoid it by going a little bit of discount point and a little bit of interest only payment, maybe a little bit more money down, it generally becomes much better for the client to stay in that 0.75 to 1 bucket. However, we do have no ratio as an option for those extreme cases. Eligible properties. We'll do DSCR loans on single family residence, PUDs, 2 to 4 units, warrantable, non-warrantable condominiums, and condotels are essentially so restricted that they are very, very hard to do. It is possible, but condotels can become a little difficult. The non-warrantable condos are only available in the core program. I will do warrantable condos in both premium or core, and those will meet Fannie Mae warrantability standards. The non-warrantables are a little bit more like a non-warrantable condo you'd expect. They do require a full condo review. So that's going to bring in the complexity of both a DSCR and a non-warrantable condo. LTVs do get in the condo space. So max LTV for a DSCR condo is 75 LTV in Florida only. I will do higher LTVs around the country, but Florida is a 75 LTV max. One of the other things we run into a lot is rural DSCR. Unfortunately, rural DSCRs can be very difficult to structure. They need to be in a vacation area, and they have a max of 65 LTV. Although there is some exception potential to get that up to 75 LTV for the right DSCR, it is a much more complicated thing to consider. You will also need to make sure that on a rural property, you do not exceed 2 acres in parcel size to conduct a DSCR loan. It's a 2-acre maximum. If you have a rural property as an investment, I would really encourage you to look at some kind of business purpose income qualified loan, not a DSCR. So the borrower profile, you're really looking for a 640 plus FICO score. Ideally, you're going to have somebody with a 680 plus FICO score to open up the most amount of options. That 85 LTV does not open up until 720, which is where you start to see premium pricing now for DSCR transactions. We don't need an experienced investor, right? We do have first-time home buyer requirements that are a little bit tighter, but that first-time investor category is pretty wide open in my core product, and you can price better as an experienced investor in my premium product. In the core, we will also entertain a couple of potential late payments. So realistically, I want to see no more than 1 late payment. We have done files working with up to 3 where it was kind of a rolling situation, but that is a ever-changing guideline in the market right now. So that you may see some tweaks too, but the late payments, we can't have 1. That is aggregated across all mortgages on credit, though. One of the important things to consider as you're packaging a DSCR file is your VOM screen. We really don't want any property on that VOM screen that is not attached to a mortgage on credit. So if it doesn't show as a mortgage on credit, I don't want to know about it. I don't care. I only want to verify that mortgages on credit are current through the month of closing. I don't need to know the payment for any DTI or anything like that. I'm only looking at, is the mortgage, property taxes, homeowners insurance, and HOA on those mortgaged properties current. The one exception to that is on the borrower's primary residence. That I always need on there, and I must verify their primary residence if it's mortgaged. If they are a renter, which they can be, you can be an experienced investor that owns rental properties, but still rent. At that point, I'll want a 12-month VOR. If that's an institutional VOR, I will take the VOR by itself. If it's a private party VOR from an individual, though, I will ask for 6 months proof of rent payment. Structuring the deal, the first thing to look at is the DSCR calculation. Let's figure out how to make that property a 1 or better. Second component is let's make sure we've got our 6 months reserve. Again, as you get to the larger loan amounts, you could need a little bit more reserves, but those are much less common. So we're going to let those just sit for today. If you have your DSCR over 1, your 6 month reserves, your assets for down payment and closing costs, you've got a qualifiable DSCR deal. If you're a little short on funds to close, we do allow gift funds. The borrower must have their own reserves in their own money and 10% of their own funds invested in the transaction. However, they can use gift funds for the remaining 10, 15, 20% they want to put down. Spousal funds do not necessarily have to be gift funds if they're in an account that the spouse is not on. So we can look at spousal funds on a case-by-case basis. A lot of times those are usable as non-gift funds, but sometimes it's easier to document them as gift funds anyway. Typically, we ask that those gift funds get wired directly to title. We get a gift letter, documentation's done. That keeps it nice and simple. Again, reserves have to be always the borrower's own money. They can never be gift. And one big restriction we get asked a lot of questions about is gift of equity permitted on a DSCR, and unfortunately it is not. I will not accept a gift of equity on any DSCR transaction. If you have a property that has been inherited, though, I do not have a seasoning requirement. If your borrower inherited a property out of an estate, you can do a cash out refi for that, or even a rate and term if they're just paying off mom's old loan. They're both priced as a cash out in this scenario because of the new ownership, but there is no seasoning. They can inherit that property today, start a refi today. Generally speaking, for time of ownership, I do require a 6 month seasoning period before we pull cash out, but I will do delayed financing or pay off a hard money loan via rate and term at any time after the purchase. So you can do a rate and term refi or a delayed financing cash out in the first 6 months. Otherwise, you need 6 month seasoning to consider. So the investor has to have owned that property, note date till closing date, a minimum of 6 months to get cash out.
We have a few questions on the chat.
I just saw that.
The first one is from Mike. Would a short-time rental work in a rural vacation area?
Unfortunately, I will not stack short-term rental with rural. The default rate right now on the short-term rentals as a holistic nationwide option is not the greatest. So it's a place where risk is being a little more restricted. So unfortunately, I won't work with short-term rental in a rural area. We're looking for that mostly at the beach resorts, the more common kind of Airbnb rentals. And I know that there's plenty in areas like Gatlinburg or Asheville, North Carolina, but unfortunately, that's just not a restriction. That's just not a workable one in my guidelines. And there is a Baltimore City. Yes, Baltimore City is currently restricted, is Philadelphia, both due to appraisal fraud in those markets. So there is a list. It's under geographical restrictions on the matrix published on the webpage of areas that we do take issue with in terms of DSCR lending. Baltimore, Maryland, specifically Baltimore City, is a problem in the DSCR space, as is Philadelphia. Those are the two highest concentrations right now from a fraud perspective, and those were all appraisal-driven fraud, so I expect that restriction to stay around for around 2 years until those comps have time to work their way out of the system and we can get some clean comps that weren't affected by the appraisal fraud. Short-term rental, if you have one to do it, we just did one down in Florida, actually. We closed it yesterday. The DSCR ratio must be a little enhanced. We're looking for a DSCR ratio of 1.15 or better to qualify a short-term rental. That is a 0.15 higher, obviously, than my DSCR of 1 requirement on other programs, other housing income calculation types. I will also apply a max LTV of 75% or the lower on the matrix for any kind of short-term rental program. Realistically, I need a purchase short-term rental with performance history or a schedule of rent provided by an AMC. Most AMCs nowadays will do an alternative schedule of rent as opposed to the 1007 because they're not allowed to put short-term rents on the 1007, but I will accept that as well. In some instances, you can use AirDNA. However, that data has a quality statistic attached to it, and generally speaking, we find that that quality statistic is never high enough to meet guideline requirements. So I'd always prepare to get something done by the AMC. On a cash out refi, you can still use STR to qualify, but I need to show a 12-month performance history from an online source. So I'll need Airbnb or VRBO printouts to show me that performance history on the short-term rental. No ratio and negative cash flow, unfortunately, are not eligible for short-term rental. It's got to be that 1.15 or better. And a notable exception to short-term rentals, because it's not strictly legal in the 5 boroughs of New York, we cannot do it in the 5 boroughs of New York. So one of the things we are going to qualify short-term rentals for now is that the local municipality does indeed allow short-term rental. We're seeing more and more restrictions on the local level disallowing short-term rental as a rental option. So the local municipality must allow it, and that's generally confirmed by the appraiser in the marketplace. What we like to do here at MLB is leverage our knowledge of our own guidelines plus our experience. For those of you that don't know her, Celine is on the call. She's talked a couple times. She's got a background in third-party processing. My background is very heavy in loan origination. I also packaged and wrote our guideline books. Let us use our years of experience and our knowledge in depth of our guidelines to help you structure a deal. The right time to talk about that deal is before it's ever submitted so that we can make sure it's structured and built the right way. We love to help you guys get them built, structured correctly, and in the door right because it gives you a much better experience. A little bit of legwork up front can really improve the overall feel of a transaction for you and your client and avoid any issues. A lot more things we can fix before application than after, right? So please do leverage us, do use the phone numbers. We want to talk to you about deal opportunity. We'll talk to you about any deal you want to bring to us. We may say no to some on the more creative or more risky side, but a lot of times we'll also know who might touch that deal if it's possible in the marketplace. So I do stay quite in tune. I'm happy to be that resource for you and point you in a direction. If I can't do it, I'm not going to hide who can from you. I'm going to try to give you the resource so that I'm the first call next time. Does anybody have any other questions or scenarios they want to talk through? If you do have a question, feel free to unmute yourself. We'll stick around for a few minutes. That's the end of today's webinar, but we're more than happy to stick around for questions or any scenarios anybody would like to talk to. Again, also feel free to email or call. We've got the non-QM scenario desk, which Celine put that email in there as well. Soon to come will be a non-QM deal structure desk, so be on the lookout for that. We're looking to package that together and actually help you with a deeper look at your file, build loan structure for you before submission. Thanks, Joanne. Thanks for coming today. If nobody else has any questions, we will see you again next week. We're going to spend some time talking about asset depletion, asset utilization as both a standalone and a combined income type in the non-QM guides. Thank you all. Have a great week. We'll see you next week.